And again, good morning, everyone. Thank you for joining us on this wonderful Wednesday morning here in September as we begin to approach the end of summer. Just a couple of days till the first day of fall. This is Mark Contra at the Messer offices outside of Charlotte, North Carolina. And again, today what we hope to do is bring to your attention information of products from one of our carriers that will allow you a better opportunity in the marketplace to fulfill your clients' needs. Before we get started, we want to make sure just a couple of things. Number one, that your phones are muted, so that just in case there's any feedback, if you hear it from your side, it might be your office, so please go ahead and mute your phones. Again, today what we're going to do is wait until the end to answer any questions. Those questions can be typed in the question box you'll see on the right column screen, and we'll address those again when we get to the end. And this morning, I'd like to introduce our speaker, me. Apparently, we've had a miscommunication with the representatives of MassMutual, and they're not prepared to be on this webinar with us this morning. So again, I do apologize for that. What I'm going to do is take a few minutes here this morning to talk about the company, the products, and then I'm going to introduce you to one of the strategies, use of life insurance, as you can see up on the screen, taming a bear market in retirement with the use of whole life insurance. So if you're not aware, MassMutual, of course, is a company that's been around for well over 100 years. They are a mutual fund insurance company, meaning that they do perform on dividend participation for their policyholders, who then in turn really become the owners. You might even refer to perhaps as the stockholders of the company, those people that are receiving those benefits of those dividends. The products that they offer, as we can talk about today, starting on the whole life or the life side, of course they offer a term product, and it is the Vantage term product. With that also, we can go over to the universal life products, and then we can talk more about the whole life product as we're going to use today in our example. On the term products themselves, the Vantage term, I guess first of all, let's start with the fact that if you want to sell any of the products with MassMutual, the first thing you're going to need to do is take an application. So we've kind of got the horse behind the cart here. You're going to need our assistance at this end to either run an illustration for you or access a quote for you on a term product, and then in turn supply you with the necessary application paperwork sensitive to your state of residence for that potential policyholder. Once you have that application prepared and returned to us, of course we'll scrub it the first time, a lot of detail in their paperwork. We'll submit that application, and upon submission we'll also include over to them personal information on you, so that they in turn will send to you an email which will be used for you to log in on that link and do the actual contracting directly through to their surface. So those would be the steps. Let's get an app going, then we can get a contract going, continue on the underwriting process so that that application gets completed, the policy gets issued, and so, of course, so that you get paid. With this particular carrier, for your knowledge, touch on a couple of little things that are different. You may or may not be aware that recently, this year, MetLife decided to close its captive office sales. What they did at that time was focused on an agreement with MassMutual, allowing those representatives to move over under the MassMutual direct program. Now, agents for both MassMutual and for MetLife that are captive go through the necessary training to become Series License 63 and 6, so that they in turn will carry that focus call of a financial representative and represent the companies that way. So basically, what I'm saying is that MetLife removed themselves from the captive sales team position in offering their products. Also, they pretty much closed their activity on the sales of those type of life products because they were moving that portfolio of interest over to MassMutual. You may or may not be aware that, of course, Metropolitan Life was also a mutual company for well over 100 years, and they demutualized. I don't remember the exact year, but somewhere in the late 90s. And what that meant was they no longer were going to be a mutual funded company, and instead were going to be responsible to the stockholders that would be purchasing or receiving the stock in MetLife. Some of the way that was done was MetLife actually turned over to policyholders X number of shares based on their longevity and the time and the dollar value of the policies that they hold or held at that time. They also offered additional benefits to that stock purchase to those policy holders, and pretty much backed themselves out of the responsibility of paying the dividends again to those policy holders who are now becoming stockholders. So that's what the demutualization kind of in a nutshell came down to. So again, now we advance further today and we get into the scenario where MassMutual has come into the center of focus with them. And there's a lot of things going on behind the scenes. Some of you may have heard of Rule 49, talking about the fiduciary responsibility of agents in the sales of certain types of products and how that would work going in the future, and how those representatives would be held financially responsible for decisions that they make or decisions that they lead their clients to make, let's say it that in a better term. And with that Rule 49 coming into effect, of course, it's going to be more important for more people to be seasoned veterans in the business and recognize, again, that fiduciary responsibility in determining those products that are going to be a best fit. But also behind the scenes, what was going on, and you have to really dig into it to understand, is the Department of Labor was recognizing the fact that many of the companies that were packaging portfolios to sell to their clients, they were giving special interest to those portfolios that they themselves were packaging. Okay, which makes sense. I mean, you're in business, you're trying to sell your products and your goods, and they were leading their clients then to those particular products. And what the Labor Department came out and said in that Rule 49 was that, that should not be taking place, and it shouldn't go forward further, so that companies recognize that in their efforts, and let's take a company like MetLife that was packaging those type of products to intermix with their variable life products or their variable types of annuity products, they were going to have to dispense of that type of activity. So what really made more sense was for them, because of their background in business that way out of New York and exposure all these years, was to kind of back off from that selling position but still be able to package the products. And that is really, in a nutshell, the relationship that becomes developed between MassMutual and MetLife, in that now MassMutual can in turn present those type of products that are not produced by them from their own portfolio, and again in that relationship with MetLife. So it's not the whole gist of it, but it kind of gives you an understanding a little bit better of what kind of is going on behind the scenes. Then again, when we talk about the products that are available, I did mention the UL products and the types of UL products that would be available to your consumers through MassMutual. You're not going to have an index UL offered by MassMutual. One of the best products that they do have, though, is the Survivor UL. If you're not familiar with that product, please get in touch with me or do a little bit of your own research and study. It was one of the products that I lightly touched on and the benefits that it offered when we had the expo last week. All of you who were there, thank you very much for your participation. And for those who weren't, I'm sorry you didn't have that opportunity to join us in that presentation of information and learning experience that was available. But there are certain times that a survivorship UL fits the needs of your clients much better than any other product, because basically it's a second to die product. So you might say, oh my goodness, why would I want a product that has two people insured on one policy, and when the first one dies, there's no benefit paid to anyone, and nothing is paid into the estate until the death of the second party? Well, one of the first and primary places you might have a use for this type of a product is someone that has a high insurable risk, or perhaps not even insurable. The fact that they can do a joint policy and be together on that policy, and it be issued jointly, and it will be weighted based on the healthy person more so than obviously on the potential decline of the unhealthy person. So that's one area to recognize when you're doing a joint and a second to survive. Again, too, then, is the purpose of having that policy for those clients for the survivors. I'm going to throw two issues out at you today that are probably the best opportunities that you would have for someone to use that type of planning in their estate. The first one would be someone with multiple millions of dollars in their estate. And even though they may do a number of things in a best effort to prepare for the inevitable event of the taxable consequences, it's highly unlikely that they can cover all bases. One of the benefits of having this type of a survivorship life policy would be for that estate to have the settlement from that death benefit to pay the taxes that would have been incurred from the estate. Not really having an example here to throw up on the board, but just to give you for numbers' sake, if you have that couple set up on a $1 million survivorship UL, and the taxable consequences to that estate happen to be $750,000, rather than the estate having to divest of specific interest in order to pay those taxable consequences, they would in turn use this death benefit, a portion of it, that's $750,000, pay the taxable consequences, allow the survivors of the estate to inherit as they would the benefits of the estate without a taxable consequence, and still add an additional $250,000 to the estate and its benefits. So that would be one very good reason and place to use a survivorship UL. Second opportunity that you might have to use that particular format would be in the case of a special needs child. So taking that client into consideration that has that special needs child, first and foremost, those parents are very concerned about the welfare and well-being of that child when the day comes that they're both gone. Who's going to take care of them? Well, there's probably no better program than setting up a second to die survivorship UL than for the benefit of that special needs child. It also may be used because the parents need to protect the interest of that child from other family members whom they do not feel would have the same concern and care to take care of that child. So they can preempt that by placing into effect a policy like a survivorship UL, again, to take care of the benefits for that child. Then, of course, we can go over to the permanent products on the whole life side. And you're going to have a number of options to work with. Your traditional whole life product, as you probably experienced in any of your sales with companies of whole life, is what would be called a pay to 100. That's pretty much the routine, the average product that's offered. But one should also consider, when dealing with your clients, the younger they are, breaking those policies down into performance periods so that your premiums are controlled over a set amount of time. Ideally, if someone is younger, ideally 20s, 30s, if you can align them into a pay to 65 product, knowing that by the time they reach that age, they're done with all their premiums. Their policy has been growing in that format for anywhere from 30 to 40 years, and they can truly look at that as a plan to be used for retirement. Also, you can look at plans like this and do them over periods of a 20 pay, which would mean they would pay on it for 20 years. Perhaps that would work well with someone in their later 40s. Again, they could still do a pay to 65, but maybe you just want to cut it to the quick and do that as a 20 pay. Then, of course, you also have a 10 pay. So again, as they age up, if you want to allow them that opportunity to be able to have that policy paid for before, again, they reach age 65, you might go into a 10 pay format. Products available there with that whole life, and again with the illustrations that we would be more than glad to assist you with. So again, today what we're going to do is we're going to turn over and again to the screen that we have before us with the Taming the Bear Market, and basically we're going to use whole life insurance as an alternative option. We're going to talk about use a couple examples in the presentation in an effort to kind of bring it into full circle for us. And again, as we're all aware, the much changing need of our seniors today in the retirement landscape. Very good percentage number based on the information provided here is that someone should plan to have at least 75 to 85% of their pre-retirement income available to them in their retirement years. I think we're all aware of the fact that we continue to hear the greatest fear that people have is outliving their income in retirement. So again, this is kind of a little place to determine and place that marker and say, you know, if you're making $100,000 a year, you probably need to make sure you're going to be able to have $75,000 to $85,000 coming in when you reach that retirement picture. Also, when we're looking at it, as we come into the question of risk tolerance with people, a lot of people are more concerned about the safety of where they can have those funds. Those who may not are going to take more advantage of the marketplace where they have more tolerance in their risk. A gentleman by the name of Phil who's going to retire, or would like to retire when he reaches the age of 65. He will have accumulated approximately $500,000 into his qualified plan. And if he decided immediately to begin to take distribution, he would find himself pulling approximately $37,500 out of that for his distribution. But when we look at the hypothetical situation in this account, and we take that $37,500, and we look at the earnings based on the S&P. Now, again, the timetable that we're working with is all the way back to 73 to 87. So they're using this 15-year period for a couple of reasons, to show both positive growth and the situation of negative years of index responsibility, so that we can look at the entire picture of what would happen with Phil's portfolio. So when we look at it and he starts to draw from that 500,000 pool of money that first year, leaving him with a balance, if in fact that year there was a negative return on the S&P and his account balance has now dwindled down to under 400,000, again next year when he goes back in to take out that same systematic withdrawal number, of course he's going to have even a smaller balance to work from. So again, in this example that we're using today, as you follow it through from the first year is 65 and the second year, the losses. The gains that come back in again in the third and fourth year, in the fifth year again a loss. And then again as it builds up, back and forth, back and forth, back and forth, as you can see what's taking place. Again, if we just drop all the way down to that 15-year window, we've taken the $500,000 down to a balance of about half. As we've withdrawn from that $37,500. And again, we're coming down to a balance at the end of the first 15-year window of about $225,000. What we want to show here, though, is with an alternate approach of what could take place. If Phil were able to avoid taking distributions during those years on the account that had the negative return and still had something outside, again, to get those funds from, we can see in the picture of the numbers, obviously, the benefits that would take place. So, taking that first withdrawal, having that first effect, but then not taking those withdrawals in the next year's second and third, so that we don't continue to diminish the account from the funds themselves on the systematic side. When we come to the end of that 15-year period, and again, every time there was a negative in the market, we avoided taking a withdrawal that next year. When we reach that 15-year window, obviously it's a huge difference. We have an ending year balance of $837,000 compared to that ending balance of $225,000. It's kind of a wow. So in turn, when we raise that question, we ask ourselves, what can we do today to prepare on an alternative means so as not to have the impact of that short-term market volatility? What we look at is we're going to assume that Phil met an agent like yourself that had the prospectus to show him he should purchase a whole life product and pay his premiums to age 65. So again, we could have done this on a chassis for pay to 65, or in this case a 20 pay. It would have accomplished the same results. So he paid that annual premium, allowing him to accumulate that cash value and defer everything in retirement from that tax basis. He will then take partial surrenders from the cash value of the policy. And again, these are partial surrenders of cash value. By doing this, he will have the benefit of doing it again tax-free. We have to get into the numbers crunching, but the fact is that he's paid premiums of $7,000 for 20 years. So right there, just a quick number is we've got about $140,000 of premiums paid into this policy. So anything he's withdrawing at that time, less than that original $140,000 of premium paid, of course, is really tax-free because it's his own money that he's really getting back for what he's paid in. He can, again, with that, defer that tax. And he has, again, allowed himself that opportunity to work with these dollars. And if, in fact, he chose to, one additional thing he could have done was added the extra layer of protection with a waiver of premium, which, of course, would have been greatly beneficial in his early years had there been an issue for a disability claim, so that those premiums would have been waived and that $7,000 would have been paid based on his disability. So when we're looking at that whole life policy now, and we're saying that it had developed over that 20-year window, again, to a cash value of approximately $210,000. That benefit, originally as we wrote it, was $250,000, but due to the dividends that were paid into the policy and the paid-up additions, the death benefit has increased to $375,000. But again, what we're focused on here is the cash value that we're going to use to surrender during those years that matched the years when the market was down, where we chose not to take it out of our market accounts, so that yes, we did depreciate the cash value on the policy side, but again, without damaging that entire portfolio. And you can see again, as we come down to that 15-year window of time, where we had started with a death benefit of $375,000, taking those withdrawals during those periods of the bad market, not taking them from this, but again, going back to our marketplace systematic withdrawal, allowing our policy again to begin to grow. We wind up at the end of the 15 years with the accumulation of a death benefit once again equal to where we started at age 65, 66, and with a cash value that has actually grown even more than when we started taking those withdrawals. So again, as we're looking at it, we're seeing that we've pulled out approximately $100,000 over that 15-year window of time. So again, as this alternative would show, using one versus the other, and now we're looking at, again, the taxable consequences here of that whole life policy versus, again, the taxable account. So we have, again, the value in our cash account, and again, the value in our death benefit. Little note down here at the bottom, you'll also read that at age 75, that value reflects the required minimal distribution, which happened to be $19,500. Rendering an $18,000 income to a equivalent of an after-tax value of about $13,000, assuming a 28% tax bracket. So, is it right for you? Well, it's not going to obviously be right for everyone. The supplemental retirement income strategy, used wisely by the right family methods, can again assure the legacy of that family and do it in an income tax death benefit plan. The example that's here again is on that client field that we talked about, again a 45-year-old. And this is good to see too for you, because this is really how an illustration is going to be produced for you, for your client. It's always good to learn how to read these illustrations and understand them when you go to your client's home. It's one of the things that I probably focus on most when I assist an agent here, is to be sure that they do take the time to go through the entire illustration. So again, we've got Phil, he's 45. We ran him through here as a select preferred non-tobacco. Again, we talked about that $250,000 policy that we did add. Remember that annual waiver premium benefit, and that's where again we ascertained, or the illustration did for us, that premium of $7,000. Also, it's highly important to recognize that as it's illustrated, this would not become a modified endowment contract. That's good. But don't ever fear the fact there's going to be times when you run illustrations and you use large cash initial deposits that you will run into a modified situation. Again, the purpose of the policy, though, in the future as it grows, many times will eliminate that consequence. But again, as this one is designed today, it simply is not a modified endowment. Again, the narrative summary is so important that one takes the time to go through, recognizing each little individual part of it, because understanding this, you'll find yourself in a best position to answer the questions that the clients normally will ask, and you'll look like a genius because you took the time to do your homework and study what was there. So we're also showing in this particular illustration, we're going to use a dividend option for paid up additions for all years. You're going to see that when we get into the number crunching pages of this illustration. Also, it's always important to make sure, and that's why it's boldly printed, that dividends are not guaranteed. I can send you, if you have interest, the dividends and the dividend history over basically the past 20 to 50 years in the case of MassMutual, so that you've got something that you can show a client that's true facts. But again, we always have to be cautious in our wording and always make sure we volunteer the fact that dividends are not guaranteed. The policy automatically included the accelerated death benefit rider at no additional cost. It also included the transfer of insurability rider, which, as you can read here, provides that policyholder the right to actually transfer or exchange a new insured in place of the current insured. So it's a little tricky, but it can be done, provided that that insurable interest exists between the owner and the person being substituted. And again, they also make sure that that new insured is not older than the age of 75, and they do need to still provide evidence of insurability. This also is included at no additional expense. We talked about the waiver of premium rider. I think all of you are well aware of the fact that that basically means that in the case of a declared disability, the premiums that may have been due will be paid by the policy itself, not from the policy, but by the carrier, so that the policy will continue into effect just as if that policy had been paid. One of the reasons that you might make a note that you would want to sell a legacy term product from MassMutual. So again, I'm kind of changing gears on you guys and gals, but the important thing is to know that, yes, the premium you will find will be higher on that product than if you're just shopping term insurance. They're not going to compete in that race. But a guarantee that you have with them that you're not going to have anywhere else, should you write that term policy, and let's just say, again, it's a $1 million term policy, and it's this 45-year-old individual, and you write that waiver of premium rider to it, and that person does become disabled, well, of course, that premium is going to get paid on the policy. But here's the home run. That policy that they have on that term product is going to be convertible to any permanent product in that portfolio. So that would mean that they literally could take that $1 million term product on disability, convert to a $1 million whole life policy that the premium would be paid by the carrier. Let that one sink in. So there are reasons and times when you may want to choose to sell a higher price term product because of the benefits than just selling premium. Again, a complete breakdown in the narrative here. You need all of these little definitions, as you see here, statements to the left and definition to the right, as we get into the actual illustration itself. You're going to have the narrative summary, which is just going to show you the premium, which we've been talking annual, which they could break down to monthly. The actual numeric summary requiring the signature. Another little thing that comes up when we talk about illustrations, and sometimes agents miss it, let me scroll down to the bottom here. You'll see that this is page 10 of 15. So yes, it's important. Your client signs it, dates it, you sign it, and you date it. But when you return this illustration to us with that application, you need to make sure that you return all 15 pages. So yes, even the silly little cover page designates to this particular illustration, and that will be required by your administrators as they process this paperwork for you. So don't miss that, and don't wonder why we call you and say, we need all the pages. We're not trying to be difficult. It's required. I've seen agents that lost the pages. Well, if you lose the pages, then you're going to need to have another illustration run and go back and get page 10 again, signed and dated, because I've seen them try to run another one and substitute a page, but what happens is the dates don't match that are on the bottom here when it was prepared. Something else doesn't match. They get caught for trying to slide it through, so don't do it. Process the entire illustration to us, or if necessary, have a new one run, get the signatures, and again, send it in. All right, so now we're actually getting into a page on the illustration that you can look at, and you can see what's happening with the numbers. We're basically going to talk about two sides to this illustration. So if we use this bold black line here, we are separating the guaranteed side from the non-guaranteed. We are guaranteeing this client that should he decide to pay this premium for the 20 years to age 65, the cash value at the end of that period will be this amount, maintaining that death benefit of $250,000. On the non-guaranteed side, we are going to show the annual dividend. That dividend in this illustration is based on the current dividend being paid. So that will differ by years after the dividend is declared as to what that actually will be. But again, for the sake of running the illustration, they have to lock onto something to use through the course of time. So they lock on the current dividend itself. Obviously, that's an addition of cash value to the policy. It also will purchase the paid-up additions that year so that the $250,000 death benefit with the paid-up additions, and again, that was a rider that we designated. There is no cost to the consumer, just a matter of marking the box. If you don't mark it, we'll mark it for you, because this is a benefit you want your consumer to receive, has increased that death benefit by that same $1,653. So there it is right there. So every year that those dividends are being paid, it's accumulating additional cash value. It's buying additional insurance, which is giving an increase in that death benefit, which is how we go to that year 20 to show the accumulation and the growth, obviously, of that dividend each of those years going forward to put them in a position of having actually $360,000 of death benefit versus what they purchased at $250,000. Now, if we continue to look at it on a page-by-page basis, without attaching any of these benefits, without doing any loans against the policy, you'll continue to have that guaranteed cash value growth. You'll continue to have, as experience has shown, dividends, and continue to have that death benefit increase based on those paid up additions. So here we are at age 100. Again, no difference in the actual death benefit on the guaranteed side. We have accumulated the guaranteed cash value equal to the death benefit at age 100. But again, based on dividend and reinvestment of paid up additions, we've got an accumulated policy growth to $1.1 million. Takes it all the way out to age 121. Again, dividends are not guaranteed. Here we're going into some of the supplemental value, and again, what we're trying to determine here, and again, this is all under the non-guaranteed illustrative value. What we're doing here again is talking about, with this particular applicant, Phil, after we built this policy up, this is where we decided to go in here and take out those withdrawals to make up against the bear market and the losses that potentially would have happened had we attached his equitable funds. So we're showing directly how that affects the policy, how it affects the net death benefit, and how it actually affects that net cash value. Cash value first here, and then the death benefit here. Again, there's 2 of those 4 years that we discussed. Oops, I just blew it up. I didn't. It's actually better to look at. We'll leave it there. Here's 2 more of the years that we opted to take it from the life. And again, it continues to show the growth in that policy, those years that we're not making those withdrawals. And again, it continues to accumulate so that when we reach that age 100, we have a death benefit almost of $750,000 on that $250,000 policy. So that pretty much brings me to the end of the illustration this morning. Let me check my box here and see if we have questions. Here's one of the interesting ones. I saw a commercial about MassMutual's final expense. It was up to $25K. I think it has no health questions, like a guarantee issue. What do you know about that? Well, you're absolutely right, Josh. If you could turn back the recording a few months, you would have seen that same ad from MetLife. As I started my presentation today to kind of discuss the relationship that's developed over time between MetLife and MassMutual, I was, first of all, awe-stricken when I saw MetLife was doing a final expense plan, because I have to acknowledge at one time I was a captive MetLife agent, and all I ever heard was they would never offer a final expense product. And then I saw it advertised, and I kind of got a chuckle out of that, as I am again this morning. But you're absolutely right. That is a product that is available to the consumer. However, that is not available to us, Josh, to sell from our broker agency relationship. That's going to fall back into their market of call center activity, just as it's advertised to do, and selectively to their own captive agents based on that captive agent's performance. So, sorry, Josh, I can't make that available to you, but that's okay. We got plenty of other outstanding final expense companies that we can match and beat them. I guarantee that. All right, so let's see what we have here. Paul is checking in this morning. Is there a tool to run multiple whole life comparisons on a client like we do for term? Great question, Paul. Unfortunately, no, there's not. What we have to do is run each one individually, which is a very good point you're bringing up. Ladies and gentlemen, if you're not familiar with it, you want to be able to access WinFlex Web. So that would be www.winflex.com. WinFlex Web, WinFlex.com, basically, not the web. And then you want to register. Then you want to click on the carriers that you are appointed with. WinFlex will allow you to illustrate any carrier you're appointed with. So what can happen with that, Paul, is that you can run, let's say, a permanent product illustration, in this case with MassMutual. You could then, with that same client, change carriers, pick another product from that new carrier. It will pre-populate for you the basic information, and you can then run another quick illustration. So it's not like a start from scratch to finish, but you do have to do each one individually. So again, you want to make sure you get registered and you are using the WinFlex Web. It's just a very convenient tool. But again, you've got to be appointed with the carriers, because what happens when you go in the first time, you request the carrier. The system is doing a back check behind you. Within 24 hours, it approves the carriers that you are appointed with. But if you do happen to pick one that you're not appointed with, when you open it up the next day, you will not have access to their software until, again, you get that contract completed. So take that step and, again, use the Messer tool and do your contract. Okay. Oh, Gilda, good morning. She'd like us to repeat that info about a term conversion. Well, you need to look at each individual company's product when you're talking about a term conversion, but I was highlighting the benefit of using the MassMutual term product called the Vantage Term, and adding on that product the waiver of premium benefit for disability, so that when you convert that term product, which you can do with or without the waiver, don't get me wrong, you could still convert that term product to any permanent product in their portfolio. The benefit I was trying to accentuate was that should a disability occur while on a term product, you would have the opportunity to convert to a permanent product, again with that benefit being paid because of the disability rider originally attached to that term product. So that's what I was talking about. If you have any more questions on that, please do call back in. Okay, let's see what we've got next. Here we're getting into some semantics here, and I guess a fair question, but very difficult to answer, and that is, if you were buying a permanent insurance policy, would you prefer a MassMutual whole life policy over an IUL? Well, we're talking totally different products, totally different needs based on the client that we're working with. So I can't just say yes to either yes I would or no I wouldn't. We would have to talk here about the client and see what the needs were and what their tolerable risks were and what their expectations were before we would be able to really say I would take one product over another. And then there's a question that really has to do with underwriting. And it happened to be a question about cancer on a client over 5 years. pretty much when we get into any type of cancer, there's a lot of information that's going to need to be gathered. The type of cancer that it had, the grade of that, the history of the follow-ups and the treatments that were provided. So if someone is a 5-year survivor of cancer, I'm not going to say they're going to be declined. There's a potential opportunity for them to be underwritten. However, without all of the details, and again, I would never try to outthink underwriters because that's not even possible. The best I would suggest we would do in that case is let's bring it to the table. Let's present it as an application. Let's allow them to give us a determination, and then based on that determination, allow your client to have the opportunity to choose to accept or decline the offer of the rating based on that underwriter's decision. Well, again, ladies and gentlemen, I thank you for joining me this morning. We're right at the top of the hour. Again, if you have an interest in contracting with MassMutual, touch base with us so that we can have an application submitted to go into that particular step. Also, again, Master would like to thank you and offer an opportunity for you to earn an additional $100 bonus for any sale that you could bring to the table in the next 30 days. Bring us an application. Let's get it going. Let's get it issued and allow you to receive an additional $100 for that particular application. Again, it's only for the people that are currently on this call. We do have you registered. Please do share the information with your other associates. Again, if you have questions, the Producer Services Department and your marketers here at Messer are at your disposal. Thank you again. See you next Wednesday. Mark Hunter, signing off.